Welcome back, traders and investors, to Benzinga's Pre-Market Prep, brought to you by MarketFi. I'm your co-host, Joel Elconin, along with Brianna Valesky, and we have Scott Red Dog Redler on the line. He's Chief Market Strategist at T3 Live Trading Group. Scott, tell us about your first ever finance festival coming up in November.
It's very exciting. I can't believe how many people that we actually locked in to present and hang out for the weekend. The dates are established. It's in Florida. You should look at our link to get like the names of everyone. I don't want to forget anyone, but you're talking about like Josh Brown. You're talking about Santoli. There's so many people that are going to be just presenting about what they do and how they do it, and then also getting a chance to hang out and play some beach volleyball, have some dinner and cocktails, and it should be really good. It'll be a great way to just gain market knowledge and have some fun and do it at a pretty low cost point of entrance.
Who should go, Scott? Should day traders go? Long-term investors go? Who what kind of audience are you going to get there?
I think we're going to get a little bit of everything. I think that with the big spectrum of speakers we have macro guys talking. We have people that focus on intermediate trends, active trends. You have some just who are pretty fundamental. You have people that are technical. You have a lot of market personalities. So I think anyone that wants to know anything about the market, and themes for potentially 2016, why not go to this? There'll be some breakout sessions where you get X's and O's, and I kind of go over my Red Dog reversal and how to trade intermediate trends, which is where I typically make my cash flow, and then how we come up with some themes for longer-term investors, or how longer-term investors could even, come up with the plan to outperform the indices by just making small adjustments a few times a year. So there's going to be lots of different ways to learn at this festival. And I feel like if you're involved in the market and you tend to do more than just read the newspaper every day, I think it'll be for you.
Yeah, I see our buddy J.C. Perez is going to be in there. He always gives great commentary on our show as well. So looking forward to that. We got a question earlier in the chat about the 200-day moving average here. And I just noticed here on your morning note, as I'm trying to bring it up here and not doing a very good job of it, you have significance of it. So let's talk about it, basis the spider here, and what you're looking for here with the spider and the 200-day moving average.
All right, well, you think about the move that took place, the 2-week move from the 200-day back to the highs of the range, the channel. It was fast, it was furious, it squeezed pretty much any early short. And then, once we paused last week, we were talking about, can 2100 hold, can 2110 hold? Will that hold the top, 0.3825 Fibonacci retracement to keep some momentum, to keep the range higher, so then the next time it tries to break out above 2130, you would have more success. So I know for me, I was looking to be a buyer of the spiders around 211, 211.50, in that area on Thursday and Friday, and I actually went away for the weekend. So on Thursday, all of a sudden, I had 4 or 5 longs, and I'm thinking, okay, maybe I could be long, into the weekend, and we just pulled back 20 handles off the highs, and it could be a good spot. PFs, I checked in the afternoon. I'm driving with my car. My son, like, ooh, stopped out of Goldman Sachs. Oh, I'm stopped out of my spiders. Ooh. Out of everything that I tried to put on versus the lows. But you know what? Sometimes it hurts when you lose, but as long as you don't lose more. If I didn't get stopped out of a lot of those things on Thursday, and I just held them through Friday and then into this open, it would have been a disaster. So, you have to have like a plan A and B. My plan A was, do we hold higher and break out the highs, how I participate, or plan B, we don't hold higher, we fall right back in the range, and we have to be back to actively trading, using the Red Dog reversal, using the HSL setup, and taking a lot of caution versus trying to have risk on.
Okay, so I see that 200-day moving average coming into play, perhaps a little bit lower. Just real quickly, we just got to go over.
By the way, where do you have your 200-day moving average on the spiders?
Actually,
a lot of people use the EMA or the SMA. I kind of blend them.
No, right to the 206.40 area is where mine's coming in.
So I think that's a good setup today because you have the oscillator went out at minus 45, meaning we're very oversold. So now we're probably over 50. Whenever you're over 50, it's very hard to press shorts. And from where we came from last week into this. So you could use it two ways, like use the 200-day. If we could see 206.50, 206, 40 quick, and just say we bounce off it, you buy versus that spot. So just say, scenario A, we pull in the first 15 minutes, we had 206.40, we bounce to 206.70, you buy versus 206.40, and then all of a sudden, some sectors go green. We trade back above Friday's low of 207.60 and create that red dog reversal. Then maybe you get a nice calculated long, and then we see, whether or not the Bears stay in control. I think if the Bears want to keep control on, they probably don't let the Bulls reclaim 210.50 this week. So into today's weakness, if you're not long and you're not trapped, I think that, you could use Friday's pivot for red dog reversals in a lot of the sectors. And that's probably my strategy coming in. I'm not looking to short this open. I'm looking to see if I could play a viable bounce, but I'm not going to do it with my eyes closed. I'm going to do it versus levels.
All right, let's talk high beta tech here. And boys, since we spoke to you last, there's been just some crazy activity here. I like to look at the Goog. You like to look at the Google. You're the guest, so that's what I'll go with here. Boy, starting to give it back here. I mean, is this long ways to go to fill the gap. Had the big move up, held up there for a couple days, lost to 675 level. How you playing the Googster?
Well, I was trying, after the big earnings move, I was focusing on it, and I'm like, okay, if we're going to get continuation from the earnings move, and it's not just a one-day wonder, it could continue above 703. And then if you look 4 days later, it pushed up to 713, and it sold off pretty hard. It almost created that top and tail or a red dog reversal to the downside. So that got me, I'm going to wait and see. And then if you look at Thursday, that day engulfed the entire flag that was being formed, and it closed below the 678 pivot support from earnings. So right there, that was your out. If you were, a calculated risk-averse trader trying to be in from earnings, you got to say, I'm out of this. Because look at the size of that gap. That can crush me if I don't have the pain tolerance. And then Friday, boom, you had follow through below Thursday's low, 671.59. Now today it's down a few bucks. I'm going to look at it today. I'm not in Google. If the market's any good, this should be one of the first ones to go green. So I'm going to do it the same way I just described the spiders. Like, Friday's low, write that down to 653.18. Just say it dips below 650 real quick to like 648, comes back to 650. Maybe you buy it versus that 15-minute low or 5-minute low, and if it happens to reclaim that, 653.18, we create a little bit of a tail, and then all of a sudden we have a new point of reference to work with, from the gap. Because, if you just want to buy 650, 645, 642, and if no support comes in, there's a heck of a way, down to fill that gap there. And most traders that I know, can't sit in there for a 40-point down move, especially if they start plus averaging in with too much size.
Well, you weren't here on Friday, so you missed Amazon at one point being up over $100. Gave a lot of it back here. Boy, oh boy, now we're just kind of hanging out here near the lows from Friday. Any ideas about Amazon today?
Well, it was definitely extreme. There were shorts that were trapped and probably capitulated into that move. You have to really go to like a 5-minute or 15-minute chart to see how to trade that. There were probably some people who made a lot of money on Friday saying, we're at historic highs. I think it's a blow-off move. The earnings were good, but not enough to warrant this. And, after the 15-minute high, if you would have just shorted versus and closed your eyes and left for the day, you probably had your best day of the year. If you figured it was going to be like Google and hold in there, and you bought blindly, you got crushed. That's why you always have to have a strategy with these things. So now, my strategy for Amazon would be not to have an opinion. You have 529.35, which is Friday's low. If today it breaks below it, see what happens. See how far down it goes. Maybe it goes down to 520. If it happens to then trade off 520, go to 523, you buy that versus the low. And if it happens to reclaim that 529.35, you then have a new pivot to trade again. But again, sometimes these things get crazy where there's some talk that this was the blow off top. Mm-hmm. So if you just blindly try and buy it, on the dip and you don't do it versus a point of reference and it doesn't stop, you could be in a lot of trouble. So I would say for Amazon, Google, and Netflix, level versus level now to prove what part of the gap stays intact if you want to be long versus it, or if you're looking to short, you press versus that pivot and stay short unless it gets reclaimed, because then it could resume what was a stronger time period for the day of earnings.
All right, so we're looking back about earnings from last week, but this week we have some big things on the docket. Tesla getting up near all-time highs, and then the analysts started picking on it here, and now it's pulled back here. It looks like there's some support here at the 260 level. We have earnings later in the weekend here in Tesla. Any setups or any strategies going into earnings in Tesla?
Right here, it's kind of middle ground. I know I was long it, or I tried to be long it for a lot of the recent move, and then I was actually long. I got caught in that upgrade. That was having that downgrade. I'm sorry, by UBS. That wasn't fun. But now, if you look at the trend, since pretty much April, it's been above the 8 and 21 day, and now for the first time, it's below the 8 day. The 8 day is curling lower, and the 21 day is right here. So, I wouldn't just be blindly long Tesla. Today, maybe there's a trade. It hasn't been below the 50 day for a while, since April. So right around that 258, 259, I think that's where the 50 day is. I'd rather try and nibble on that long, especially if the market's oversold enough it bounces. This would probably be something that could go from red to green. And then I would wait to put some kind of option strategy closer to earnings. Usually the day of is best, because you have to figure out what the option specialists are pricing in for a straddle move and where the measured move is. And plus, if you start too early, you can be right. But if you're wrong the 2 or 3 days prior, you have to then buy more to be in there for the event. I tend to like to be in earnings for the event the day of, not, a few days prior.
Moving on here, I know you've been a big supporter here of Facebook. Was challenging the century mark here. I mean, considering what the market did the last couple of days, Facebook really held in there. Any thoughts? I mean, you had 2 days. Well, you had a gap and go. Then the next day, it looks like it wasn't quite a gap and go here. To me, I guess you can hold on Facebook here in the $95 area, a couple lows in that area. Any thoughts on Facebook going into earnings?
Yeah, it's been best in breed. Shorts definitely don't want to be caught here, but, and see what happened to them, like what happened with Netflix and Amazon and Google. But I feel like the more you get moves like in Amazon that gaps up and fills half the gap, or you get something like Google that gaps up and gives back almost half over a month, multiple days, if people are starting to think this Facebook better be outstanding.
Correct.
Otherwise, it could be a little bit of risk. And even if it is outstanding, chances are that might cap the recent move. There are times to be long, big size, and times to just be in it trailing wise. And at this point, if you're still in it and you've been in it for multiple months and quarters, I'd stay the course, and you've done just fine. If you're a trader, though, and I don't take stocks into earnings typically, I would wait to see where it's at on Wednesday. And right now you have a pivot high of 99.24, and if you want to trade it between now and then, be long Verts 94.81, which is last week's low. If it breaks 94.81, which is the 8 day, it could see some downside ahead of earnings. So, I would, if you're long it still, which I'm not, maybe today it goes from red to green. But if Facebook, which is the strongest name out there, can't go green and is weak today, chances are, today is not going to get, the reversal or even just some type of bounce. That it could be a clue that this market is having that much trouble.
Okay, Scott. Boy, I could keep you on for another half hour here, but at 9:15, we need to let you go. Scott Red Dog Redler, Chief Strategist at T3 Live Trading Group, joining us every Monday to give us some potential setups for the upcoming trading day. Great information, Scott. We'll speak to you again next week.
Sounds great. Thanks for having me.